We all need a Kim Butler in our life to explain that so Uncle Sam doesn't take our money from us that we work so hard for. Welcome, ladies and gentlemen, to another edition of the Coach U Show, where we interview experts. Today, we have one of the top thinkers in finance, and I've known Kim for several years now. I've met her in person, her husband, Todd Langford, good friends of Caleb Williams. There's a lot of people out there giving advice on what you should do with your money. Like her top articles on Dave Ramsey as a review, but Kim is the real deal, sound advice. And I wanted to use this opportunity to interview her so that you guys can learn from her brain. So welcome, Kim. How are you doing?
Wonderful, Dennis. Thanks for the nice introduction. It is a joy to help people with their personal finances in all 50 states from our home in Mount Enterprise, Texas.
Mount Enterprise, Texas. So you have been teaching. At first, I thought it was because you run Prosperity Thinkers. I thought it's the prosperity gospel, but it isn't that at all. It's about whole life and about infinite banking. For people who don't know what that is, how do they understand this?
Well, it's just a cash equivalent, a savings account equivalent. And, save can be both a noun and a verb. And our society has gotten away from the verb of saving. It's an act. And then you got to store it somewhere. So whole life is your storage account.
But a lot of people think that life insurance is not a place that you should be, until you're much older, or it's just about the death benefit. Why do people get this wrong? And how is whole life different than regular life insurance?
Well, interestingly enough, I think some would call whole life the regular life insurance. Nevertheless, your question's really valid because there is a ton of confusion about a centuries old product. And so it's super important to acknowledge that life insurance comes in two main forms. One of it is term insurance, and that's what most people think of as regular life insurance. Term insurance is like renting a house. It's great. You get a death benefit or a lump of cash tax-free when somebody dies, if that death occurs during the term of time. And there isn't really anybody in this world, once they turn 18, that shouldn't have some term life insurance. So you become 18, you're an adult, you have obligations, you probably have a car loan, you might be building student loan debt. You'll want to get some cheap term insurance on the web. There's lots of different places that you can do that. Then as you start to be able to save money, be able to put money away before you do your retirement accounts, before you do investing, you want to build up an emergency account. And that can be started at a bank, a credit union, something simple, but keep it liquid, make it available to you. As soon as you get past the $5,000 or $10,000 mark, you want to start storing that money in a more efficient place. And this is where the whole life product comes in. It is inside the mutual life insurance industry. So these are companies like Guardian, New York Life, Northwestern Mutual, Mass Mutual, and about 15 others in the United States. And this is a space for a more efficient place to store your emergency fund. And then you start to build your opportunity fund.
And to be able to be your own bank, as we've seen billionaires, family trusts, a lot of entrepreneur friends like me were saying, Dennis, I set up a whole life policy through Caleb or through Kim. And I said, what are you talking about? Why is it that so many wealthy families and entrepreneurs are using whole life as their bank?
It's because, again, that centuries old product just flat out works. And there are quite a few people that talk about those wealthier families who purchase a life insurance policy when a baby is born. So there's a term I want to introduce called human life value. In fact, I have a funny little saying, and it's WL plus T equals HLV. So it's whole life plus term insurance equals human life value. And a baby that's born into a wealthy family. So an example off the top of my head, some family friends of ours, the baby's born and there's an immediate trust that is established because that's what wealthy families do. That trust holds stock in the company that that family owns. The baby at day one is worth $18 million. That baby can qualify for their human life value, which is $18 million. That's 1 times gross worth. I'll come back to other human life value examples in a minute, but that family then can replace that generation's wealth upon death. So the grandparents own insurance. When the grandparents die, the tax-free life insurance, income tax-free, pays into the estate and regenerates that wealth. And then when the parents die, their life insurance pays in, regenerates that wealth. You get down to that baby. Now, when the baby is older and passes on, it regenerates that wealth. So it enables the generation that's spending the wealth to spend all of it and then regenerate it for the next generation. Now, the super wealthy families, of course, don't spend all of it, but that's what's going on.
So we hear super wealthy families that are doing this, and we know a lot of people who've come into a lot of money will set up their own infinite bank or set up a whole life policy. At what point does it make sense to do that? Because you have to have enough money to then be able to basically borrow against it.
Well, here's the fun thing. Life insurance is paid for either monthly or annually. And so you don't actually have to have, quote, a lot of money. I have 18 to 20-year-olds that have good summer jobs that are putting $100 a month away. There are 20 to say 22-year-olds to maybe 26-year-olds, first job kind of thing. They're maybe earning 50 grand. They're putting $500 away per month. And that is building their first life insurance policy. Because if you do it right, as your income rises, you're going to save more and more money. Save is a verb. And then you store that money in whole life cash value. And you build portfolios of policies, just like people build portfolios of stocks or investment real estate or whatever it is that they're building. In fact, if you do it right, you'll build them equally. Your investment arena will be built at the same time the cash value of your life insurance policies is being built. And that death benefit will stay at that human life value number, which is for somebody that's younger and doesn't have wealth, a function of their income. So that 50K a year, 22-year-old kid, his human life value is about $1.5 million or so. It's 20 times income, rough numbers. And so that is the death benefit number. And that's kind of the top. So that's where your whole life plus term insurance equals human life value. Whole life is going to be your base policy that you can afford, stack some term insurance on top, and then you're equaling your human life value. So it's a very complete picture there. And then you just build on that.
That's crazy to think that you can value somebody's life.
Think about
even
the courts.
As a baby. So, but
Absolutely.
Doesn't it require that you have like a, health scan, like what is it? A physical and all these things to make sure you're healthy, that it impacts that significantly, right?
Sure, it does. But go back to the economics for a minute. Think about the courts. When somebody gets hit by the proverbial bus, of course, there's the pain and suffering part that the lawyers are going after, but they actually use a software called PhD Analytics to figure out the economic value of that human being. Yeah. So it is a weird concept. I'll grant you that. But human life value, 20 times income or 1 times gross worth, not net worth, gross worth, is a standard in the industry and has been that way for about a century. The physical exam, interestingly enough, they're starting to waive a lot because they can get so much information about somebody over a web. They pull driver's records and other things with the person's permission, of course. But yeah, if you're over 30, you're going to get a physical exam. A nurse comes to your home, blood sample, urine sample, pretty simple. Nevertheless, there are some public environments like Magic Johnson. He found out about his AIDS because he was getting a life insurance physical. So, it's public information and we're grateful that he did.
Can you share a success story where a client's implemented whole life and has greatly benefited?
Absolutely. I have a fun one. So a guy bought a bunch of investment real estate in Florida. This has been 20 years ago. Had also purchased life insurance about the same time, pretty early in his career. He was maybe 30 and he was a doctor. So there was plenty of money. Investment real estate fails because Florida has a hurricane I don't remember which one it was.
Hmm.
And, he had insurance, of course, on his investment real estate, but that never does the full job. So he had to borrow against the cash value of his life insurance to pay the premiums for the next year. It was his third year in the policy. So this is kind of a fail first, then succeed story. And so he calls back the next year and he says, I don't have the premiums again. I'm still trying to rebuild all my investment real estate. Like, I can't do it. Well, by paying a premium, he'd risen his cash value enough that he was able to borrow against it again and pay another premium, buy himself some more time. He finally gets the investment real estate rebuilt, uses the cash flow from the real estate to pay the loan back. This takes another 2 or 3 years. Now he's whole. Well, all during that time, that cash value was growing unaffected by that loan. So life insurance, whole life insurance works just like real estate. You have an asset, you have a corresponding debt or lien, LIEN, against it. So the real estate grows, the debt shrinks. Whole life insurance, the cash value grows, the debt shrinks. And the two are interrelated, but they're not related. So now this gentleman is whole and moving forward, paying his premiums again, goes and buys some more investment real estate. Fast forward to what will be the end of the story. He has not died yet. He owns a lot of investment real estate now. He's used the cash value, borrowed against it, paid it back, borrowed against it, paid it back, not as a mortgage, but as down payment, as opportunity money to make a deal happen quickly, as repair money when he had to come in and repair things. And he will be able to utilize the death benefit combined with his investment real estate via a charitable remainder trust to make that real estate be able to be sold without paying capital gains tax. It will be a very, very valuable strategy for him. So most of these people chat with you about the use of cash value while you're living, and it's a fabulous thing, and we can use it for emergencies and opportunities. And when combined with other assets, people can utilize the death benefit of their whole life insurance. And this is not until you're in your 80s and 90s, but the utilization of the death benefit when combined with other assets is actually even more valuable than the utilization of the cash value all along the way.
Wow. We all need a Kim Butler in our life to explain that so Uncle Sam doesn't take our money from us that we work so hard for.
It is an in-depth concept, and I have lots of educational materials. So when the time is right, I know that we'll get to share that and people can read or watch or listen or whatever is their preferred way to learn about the concept that's called a pay down permission or permission to spend.
So back to the core concept of being able to save and invest at the same time, where you're able to put money that's in a place that the government can't get to, or, judgments or anyone else can't get to, and it's safe, but then you can borrow against it, which is not taking money out, to then still be able to invest in buying real estate, do entrepreneurial things. Can we think of this as like leverage when you have your own personal bank, where, you're basically borrowing against yourself at, say, 3.5%, but if you have something that makes 10% or 15%, you're basically, it's leverage, like banking, right? Where you're able to take out a loan, but still, get effectively doubled or triple your money because you're borrowing at 3 and, coming in at 9.
You are on the right track with one exception. And I'm so grateful to be able to clarify this because I think it's a very misunderstood area. And there's a lot of YouTubes and other TikTok personalities that speak about it the way that you did, and it causes confusion. So let's get crystal clear with some language. First of all, I love that you've talked about borrowing against it. That's absolutely what you do. And the money that you get comes from the life insurance company. So while I understand why the terminology gets used, you're borrowing against yourself, it causes confusion. So here's what's going on. Your cash value grows unaffected by the loan. Let's say you have $100,000 of cash value. You're going to borrow against that cash value $60,000 to go do an investment real estate deal. So your cash value stays at 100. You have a loan of 60 from the life insurance company against your cash value.
And you can't
Typically,
borrow the whole amount. So if you put 100 in, you might only get 60 or some lesser number.
no, 95%.
Oh, okay.
So I use 60,000 as an example, but
Okay.
I could use 95,000 as an example. The interest rate that you pay the life insurance company is usually a fixed rate of about 5 to 6%. Yes, there were some variable rates that were in the 3-4%. Now those variable rates are in the 7-8% range. Nevertheless, I recommend that my clients choose a fixed rate. When you borrow against your cash value from the life insurance company, you pay the interest back to the life insurance company because you used their money. It is leverage. It is the ultimate OPM, other people's money. Now, what you said is accurate. Let's pretend that the rate of the loan was 6%. Let's pretend that the deal that you invested in was 12%. That is a 100% return. You have a cost of 6, a gain of 12. That is a doubling or a 100% rate of return on those dollars. In addition to that, your cash value, so the 60,000 was getting you the 100%. Your cash value of 100,000 is over here earning you about 4.5% in the year 2023 when we're recording. And so you've got a growth of that cash value that continues uninterrupted, unaffected by the loan. Back to the loan, you have your 12% investment, you have a 6% cost. And so you have that going on. And then you can use the income from the real estate deal or whatever your investment is to pay back the loan and do it again and again and again.
So you would do this as long as the deal that you have is a higher rate of return than what you're paying. So if you're paying 6 and you're able to do it at 10 or 12, then it's leveraged and a great deal all the time. As long as it's above what you borrow it at.
Right.
So why wouldn't I just why would I do it by borrowing against the money I have with the life insurance company versus like a regular bank loan or SBA loan or other kind of vehicle?
Yeah, it's going to totally depend on the interest rate and your capability for borrowing, the speed and the hassle factor. So, for example, if you have a line of credit and it's at 2% deductible, absolutely, you should use your line of credit. There's nothing magic about the life insurance loan. Let's say we're in a different interest rate environment, though, and your line of credit is at 10%. And let's say in order to use the line of credit, the bank wants, your first child and 10 tax returns, right? So maybe you use the life insurance loan. First of all, if the interest rate's less, that would be one reason. The hassle factor is another reason. However, if I can get bank money, I'm always going to use that first and keep my life insurance money for emergencies and other opportunities. So you just have to look at the interest rates. It's never an all or nothing environment. Nevertheless, I know some people that have pulled off some real estate deals using a higher interest life insurance loan simply because of the speed and lack of hassle factor. So that's an option and something to think about as well.
A lot of friends in real estate. So I believe that taxes are going up. And the government is going to default or not default, but the dollar is not going to be as strong as it has been. Where do you think the future of infinite banking and whole life is going if taxes go up in the future?
Well, taxes go up, the dollar could, falter. There's all kinds of things that can happen. And in most cases, the life insurance industry has been through it before. So you're well aware. I mean, we're actually in a pretty low tax bracket environment now. If you look at the last 100 years or so, 110, I think, is as long as taxes have been around. The life insurance industry has been around longer than that. These mutual companies, again, there's about 20 mutual companies in the US, are literally 150, 60, 70, 80 years old. This product is close to 600 years old if you include Europe and some of the work that was done over there in the early stages of it. And so it's been through it before. Is it going to come out perfectly every single time? No. But what I do know is that over somebody's whole life, which is why the product is called that, it's designed to be bought and held until death. The use of cash value and the efficiency with which that cash value is going to grow without taxes is evidence that that is a very safe, solid, boring, yet effective product. Well, let's pretend even they decide to tax it. You still have an environment where the rate of return is usually been a few points above bank savings rates. And while it's technically tax deferred now, let's say they tax it, the life insurance companies are safer financial institutions than banks because life insurance companies store $1 for $1. They do not engage in the fractional banking environment that all banks do. So you've got a couple issues going on there.
Wow. Kim, are there questions that you wish that you were asked about this?
Well, I always think people should ask, what are you doing? Right? Because what good am I if I'm recommending something that I'm not doing myself? And so I started buying life insurance when I was 24. I didn't know what I was doing at the time, but I did. And then I learned a lot from Todd Langford's Truth Concepts calculators. And so our family owns over 20 policies on myself, my husband, our children. We have our first grandchild coming. We purchase insurance on key employees because, as stated, we build a portfolio of policies just like people build portfolios of other things. Our best investments are ourselves and our businesses. And so that's what we've chose to focus on. We've done some real estate along the way as well. And so I think that's very, very important. It's also important to acknowledge that I've made huge mistakes. I've made financial mistakes. I've made business mistakes. I call my life a series of winnings and learnings. And boy, have I had the learnings.
Well, I love how you invest in yourself and how you're a practitioner of what you preach with over 20 whole life policies. That's incredible. Kim, how do people find out more about Kim Butler and Prosperity Thinkers?
Well, we made a special video for your community. So I'll send you the link so that you can pop that in the show notes. But just the regular website at prosperitythinkers.com is available. And then people will occasionally find me at the prosperittyeconomics.org, which is our nonprofit movement as well, because we're trying to help America get back onto solid ground. You know, whole life used to be a very respected, well-utilized product, and it just fell into disrepair because of the advent of 401ks, mutual funds, and the E.F. Hutton universal life space. But I believe that it's becoming more common these days to speak about it, learn about it. And as you know, we have material for all kinds of learning styles. Watch, read, or listen. We can accommodate a learning style so that whether you're analytical or conceptual, you can gain your own confidence about this product and how it can be utilized in your life. And I really welcome people to check it out with an open mind and then reach out if they would like personal help.
Amazing. Kim, you're a fantastic educator. We need more people like you that have expertise and are helping people instead of just selling people. Thank you so much for being on the Coach U Show.
Thank you.
You're so good that every question, basically, we can turn into a snippet. So I think there's 7 or 8 good snippets that we can turn into little social media pieces that then can run to articles where you've talked about each of these concepts in more detail. And then just the overall YouTube article that we'll create on it, because there's probably 40 things that we can build off of just what you said, and then tie it to what you've already made, which is amplifying what you've already said. So you don't have to repeat yourself as much as you have in general, right? Which is what all of us do.
I love it. Awesome. So cool.
Great job.
Yeah. Well, thank you. Super grateful for you. Very glad.
And you even corrected me in a very polite way too, because I don't know this space. This is not my area.
Well, it's a really common mistake, and I'm happy to be so clear about it that I can help people get through the mud and get the clarity. So
yeah, I feel like I'm doing the same thing when it comes to digital marketing, where people, they know their thing, but then when it comes to, setting up their website and running ads and whatnot, like I see the same sort of misconceptions or things like the same way you see this when people start looking at whole life.
Well, it is a joy. And I think that there's so much room for improvement in so many of these spaces that we would be remiss if we didn't. And as you know, we've rebranded recently, and I'm good for another 30 years. I just think the concept of retirement needs to get shoved out the door.
Yeah. For active entrepreneur, life insurance, not death insurance.
Yeah, for sure. And for anybody, really. I mean, my dad is in his mid 80s, still working. My mother-in-law is in her mid 80s, part-time, but my gosh, they're active. And then I see people that are not, and it's really sad what their lives are like. It's just not a good way to be.
Yeah. How did you and Caleb meet?
Caleb called Todd Langford's office and wanted to speak with him. And I play gatekeeper sometimes. And so I ended up scheduling the meeting with him. And he was either 17 or 19 at the time. I can't remember. Desirous of learning. He wanted to come to a truth training. So he ended up finding, through just reaching out, a guy that had room on his couch. He had 4 kids. He's like, yeah, what's one more? Because Caleb didn't have a lot of money. And he stayed on this guy's couch, who was a friend of ours. The friend and Caleb came to truth training, and Caleb sat through 3 days of Todd's teaching. And then we just have stayed in touch ever since. He's learned from us. We've learned from him. It's been a really, really amazing relationship.
Yeah. And he considers you guys dear friends, which is how we got introduced.
Yeah.
Was Caleb always this incredible and bright and whatnot? Ever since I think I've known him for 5 or 6 years. And he's always been, I've never seen someone who's that wise, but is a teenager or was a teenager.
Well, he was homeschooled, as you may know, and he had that way about him at, like I said, I can't remember if it was 17 or 19 when we met him, but I know that he got through high school super fast and college, whatever he did for college, quickly. So, I mean, he had aspects of him that were sort of your typical 20-year-old or whatever, but I think he's trained himself out of all of that. And he could be 45 right now. I mean, he has the life experience of a 45-year-old, if you will, just because he's gone through everything so quickly and he's had such amazing experiences. So I'm going to say yes, he was pretty much always that way.
Yeah. Incredible.
Yeah.
Awesome,
he really
Kim.
is.
Yeah. Well, I'm here to uplift you and Todd and Caleb and all the other people that I think are amazing. And it's so cool to be able to hang out with folks like you, not just because of your expertise, but because you're just good people.
Yeah, agreed. I shot you an email with the show note link, and it has a little video that I made for your community. Okay. And then I know we'll be in touch, and your Jacob has been a joy. Super grateful for him. So we'll keep it going.
Yeah. He's another Caleb. We're trying to assemble as many Calebs as we can.
Yeah, totally.
Awesome. Cool. We'll appreciate you. And then we'll be in touch soon.
Sounds great. Take care.
All right. Thanks, Kim.